Thank you, Adam. Good evening, everybody. Let me add my thanks to that of my colleagues. Thank you for joining in this evening, whether online or here in the room. The only certainty is uncertainty itself. Benjamin Franklin never quite said those words, but he did remind us that nothing in life is certain except death and taxes, hopefully not in that order. 235 years after his death, I think Franklin's message still resonates, doesn't it? While some such truths endure, the way we experience uncertainty has certainly changed, and changed dramatically. Even as a publisher himself, I doubt that Franklin could have envisaged the ways in which media now optimise for engagement, turning stories, particularly angst-ridden ones, into information as fast food. Headlines swing from optimism to pessimism within a single news cycle, and they reflect in financial market movements that are dissected hourly, if not more frequently. And technologies that didn't exist 10 years ago, indeed some even 5 years ago, are now poised to reshape entire industries, presented in turn as a threat or an offer of limitless potential. I'll come back to this hottest of topics in a little while. Little wonder then if you're asking yourself, how can I possibly plan for retirement when the world feels so unpredictable? But uncertainty is not a bug in the system of our era. It's a constant feature we can actually plan for, preparing your portfolios to navigate a wide range of possibilities rather than anchoring them and their success to a central prediction. I think Elroy Dimson, who's an emeritus professor at the London Business School, put it most succinctly when he said, "Risk means more things can happen than will happen." The greatest risk investors face isn't uncertainty. It's letting that uncertainty paralyse us into settling for a lazy investment portfolio that forgoes returns because it doesn't take sufficient risk, or provoke us into a reactive investment portfolio that forgoes returns because it chases risks that will never pay off, incurring undercompensated transaction costs and impairing principal capital. Given that we can't see the future through a crystal ball, we need a compass. Our compass structures your portfolios to steer a true course through low visibility by using objective, fact-based analysis to cut through the noise, and by staying pragmatic so that we can take advantage of the opportunities that emerge when other investors' emotions send market prices wandering around away from fundamental value. North for us is, as some of the other speakers have already mentioned, risk-adjusted returns. Your total return tells you what's happened over that period. It doesn't tell you whether that return came from a portfolio of guaranteed bank deposits or risky private loans to unworthy counterparties. Now, of course, superannuation portfolios contain many asset types, but I think this contrast illustrates the principle. Those differences in risk profile really matter. They determine what could happen by the time you're ready to convert paper wealth into real income, and that's what matters to you when you retire. Independent ratings agency Super Ratings now publishes industry league tables based on their measure of risk-adjusted returns, and hopefully you can see that in this slide. They understand what we've always known. Resilience isn't about avoiding risk, it's about structuring for it. Because not all risks that can happen do happen, and some risks that do transpire are genuine surprises. What you can notice from this Super Ratings table is that all of CSC's investment options, as Damien mentioned earlier, have exceeded their targeted returns. And as shown in the last column at the far right-hand side of this table, something I think is far more important, is that they rank at the top of industry peers on a risk-adjusted basis and over the long term, meaning that your returns are generated from a portfolio of assets with a lower combined likelihood of disappointing you in the future. We were able to maintain these rankings over the past year by not allowing your portfolios to get lazy while continuing our work to ensure they remain structured for adequate resilience to the uncertainties arising from structural risks. Despite popular concern about equity market valuations at the turn of the last year, our process signalled that economic fundamentals remained solid. US growth was underpinned by healthy household and corporate balance sheets. Tariff announcements, in our view, were unlikely to spark an inflation surge in this calendar year. Why? Because their economic impact takes time. Importers can absorb costs in their margins or pass them through to consumers, but only to the extent that consumers tolerate higher prices and lack good substitutes. And these conditions vary markedly from industry to industry. Labour markets showed resilience as well, because while US labour demand softened, for example, demographic changes and illegal immigration constraints tightened supply at the same time. Combined with healthy household balance sheets, their synchronicity in labour markets cushioned against recession risks. And central banks continued to respond to all of that data by supporting growth instead of yielding to pressures for preemptive action against inflation fears. So we maintained your allocation to public equity markets. But as we've discussed before at previous member meetings, sources of financial market volatility increasingly include not just business cycle considerations, but a growing investor reactivity to structural risks. And these include deteriorating political governance performance and changing rules of engagement around how regional differences are discussed and policy decisions are made. Real and perceived changes in cooperation, competition or conflict between regions. Erratic, poorly designed energy policies which have become increasingly reactive as traditional energy shortages, for example, due to weaning off Russian gas in Europe and coal closures here in Australia, meet a construction pace for new energy system assets that is slower than policymakers would like or economies indeed need. This gap is a risk we've highlighted at this meeting for some time. Developed region fiscal burdens are another issue. They reflect structural social welfare inadequacies and, with the notable exception of the United States, low productivity, a topic I covered in some detail at last year's member meeting. Compromised self-sufficiency is another structural issue, as Western economic vitality has shifted from building things, including housing, to servicing others via ideas, which typically face lower barriers to replication. And national security vulnerabilities in an era of a hybrid war for critical resources, pharmaceuticals, semiconductors, magnets, precious metals. Access to all of these requires energy and technological innovation. These long-term issues sit beyond the return implications of a business cycle. They include the potential for unforeseeable events that could genuinely result in surprisingly outsized losses, but also outsized gains, depicted here with the fat-tailed cats you might recall from last year's member meeting. This evening I wanted to provide you with some examples of how we structure your portfolio and the assets within it to deal with uncertainty. Recall Professor Dimson's wisdom: risk means more things can happen than will happen. That sentiment informs my first set of examples from the dynamic asset allocation process we use to capitalise on opportunities created when underprepared investors overreact to uncertainty, temporarily pushing public market prices below levels warranted by their steadier underlying fundamentals. So earlier in the year, our process pointed to two related opportunities. First, as I've already mentioned, investors were underestimating the resilience of the US business cycle, meaning that equity market falls this year were probably a buying opportunity. And secondly, that investor uncertainty about the consequences of structurally rising US government debt was driving demand for gold as an alternative store of wealth, unattached to sovereign debt risk. We acted on those insights by exercising proactively acquired options over public equity markets, buying them in April and May as markets fell temporarily on tariff and rate worries, and that earned $33 million in a month. By holding those US equities in gold rather than in US dollars, we added a further $34.1 million for your accounts, locking in that hedging profit when the gold price crossed $4,000 an ounce. This paired strategy was designed to grow your savings rather than let them be lazy, but in a way that defended against market perceptions about the structural risk of fiat currency debasement. Fiat currencies, US dollar, Australian dollar, euro, yen, the Chinese RMB, are not backed by physical commodities like gold. Their value depends on trust in the government and its ability to manage its country's balance sheet. But we well understand that we can't get everything right. In March of this year, we positioned for negative surprises in some European bond markets ahead of regional defence spending needs becoming clearer there. We closed that trade at a $2.7 million loss when ratings agency Fitch upgraded Italy's credit rating to BBB+, the first time that's happened since 2021. But here's what I think matters. Firstly, we know we can't be right 100% of the time. You have to be God or Madoff for that to be true. Instead, we aim to make our dynamic asset allocation gains an order of magnitude larger than our losses. To date, our process has consistently delivered this asymmetric pattern, capturing larger gains while limiting downside losses. Sustaining this track record requires us to remain nimble, humble, and disciplined. Those guardrails come from our purpose-built risk management process that defines predetermined exit triggers on all our dynamic asset allocation positions. As my examples illustrate, these triggers are typically based on price or event information. You'll also notice that these particular trades were particularly short-term, with profits harvested within 1 month. The reasons for this, I think, provides some insight into how current market conditions are interacting with the way we structure your portfolios for success under uncertainty. Firstly, our risk management disciplines are symmetric. So we mitigate loss, but we also seek to participate in gains that may not persist. This part of our process reflects the principle of leaning against fear, but also, just as importantly, against greed and speculation. Secondly, our exit triggers are typically price or event related, allowing our positions to be nimble to how other market participants react to the same uncertainties. This year, that has manifested in much shorter reaction times, leading to steep price reversals even on relatively thin news. So our processes are specifically designed to be nimble, disciplined, and humble to these dynamics. It's this risk-adjusted approach to investing that enables me to talk genuinely tonight about something that I think is profoundly hopeful, building the retirement you've earned by differentiating signal from noise to identify underlying fundamental trends less contaminated by headlines, by hunting where others aren't to identify assets with real growth potential that is less dependent on the economic cycle and priced to capture upside for you, and by defending opportunistically to cost-effectively protect your savings should the future disappoint on the trends everyone takes for granted today. I've spoken to you about this process at previous annual member meetings over the past 5 years, but I think it is fair to say that this work grows increasingly complex. A decade ago, themes like energy transition, digitalisation and AI, global rebalancing, or deglobalisation as it's more dramatically labelled, degrading global governance and evolving policy transmission were all underappreciated. We positioned for them early as this slide and its timetable examples. But today those themes are crowded with capital, so we're already hunting for tomorrow's opportunities. Here's 6 more examples of how we do that in ways that explicitly structure for uncertainty. Our toolkit advances with technology, and we've built proprietary algorithms to identify macroeconomic surprises and unusual investor behaviour patterns. These insights contribute to our dynamic asset allocation. I've already given you some examples of how this process worked over the past year. Our public market access selection, helping us decide whether to invest across the full range of public market opportunities or focus on more tailored subsets. And the weighting strategies we adopt, whether that be market capitalisation weights, which favour momentum strategies, or alternative weights better suited to specific macro conditions. The second thing that we've done for a very long time is separate currency from the assets that we purchase. So we've always done this. That lets us hold compelling offshore businesses without necessarily holding their currencies if we expect those currencies to weaken against the Australian dollar. I mentioned an example earlier of how we use this, including gold now as an alternative currency to manage the risks to your savings. Thirdly, stress tests. Just as a heart stress test helps reveal vulnerabilities before they become critical, our portfolio stress tests are designed to assess how well your investments can withstand and recover from both historical and hypothetical shocks and scenarios. From these tests, we can realistically gauge diversification's real value in protecting your savings through different conditions, and where diversification alone might in fact prove inadequate, identify novel but cost-effective downside protection. The equity options, which give us the right to buy or sell equity markets at pre-agreed prices, and the gold strategies that I mentioned earlier are examples of this. And stress tests also inform the way we prioritise our private asset opportunity pipelines to complement what you already hold. You might recall our discussion last year when I gave examples of how we had increased your inflation protection by opportunistically acquiring private assets that generate inflation-linked cash flows. You might ask me, what is the scenario I worry about today? Well, I worry about everything. But high and growing Western public sector debt, a challenge I fear may be impossible to address meaningfully in our current political moment, is certainly up there amongst the things I worry most about. The US is trying to grow out of its debt, betting that AI spending delivers a productivity dividend that so greatly increases GDP that it can meaningfully shrink debt as a ratio of GDP without triggering inflation. To gauge global appetite for continued financing of the US deficit, we monitor US Treasury auction depth, and without continued willingness to buy US government debt, interest rates could be at risk of rising to levels that restrict economic activity and thereby financial market returns. I think gold at over $4,000 an ounce in October signalled that others came to share this concern, treating gold, as I said earlier, as an alternative store of wealth to fiat currencies. We include gold in our defensive toolkit, and we were tactical sellers, again as I mentioned earlier, to lock in profits for you as others drove the gold price above $4,000 an ounce. In the near term, as we discussed last year, US productivity is high and it's significantly outperforming other major economies. This has been a key factor supporting its stronger economic growth trajectory, and it leans into success with long-term debt management. Furthermore, AI investment is high at around 1.3% of GDP, and it's increasing. Indeed, AI capital spending contributed more to US GDP growth in the first half of 2025 than did consumer spending, a fun fact, historical first. In this way, I think that the policies that actually matter most for long-term US success are those that underwrite productivity. Itself a result of the notable flexibility and depth of US labour, capital and technology markets to date, an advantage that lets US businesses nimbly access those resources in ways that are fit for their strategic plans, an evolving competitive landscape, and their relevant stages of maturity. I said at the beginning of my presentation that I'd share more on how we're structuring your portfolios for the hottest topic of all, AI developments. These are particularly relevant to our selection criteria for private asset acquisitions or new builds, designed to direct your resources to private assets that we expect to be helpful in the future, are not yet as well understood by other capital providers, so there's less competition pushing up the acquisition price, and to whom we or our agents can bring not just financial but strategic capital, and by that I mean help with business design, operational structuring or distribution. For example, within your private equity allocation, we select private businesses that are creating economic value by solving real scientific and corporate problems. Today, those solutions use AI to gain operational efficiency and reduce costs across customer service, but also cybersecurity and monitoring, warehouse automation, data analysis and compliance, marketing content, and more aggressive, perhaps more interesting use cases, which include AI-driven therapeutics discovery. One of your portfolio companies is building the world's largest biodiversity database, 9.8 billion genes across 400 terabases of genetic data. For those of you who don't know what a terabase is, you're forgiven. I didn't either before we started investing in this business. It's equivalent to 1 trillion pairs of DNA. Your infrastructure and property assets are selected because they're scarce, they're hard to replace, they're hard to disrupt. So examples here include Unity, which provides fibre connections to homes for high-speed broadband, Altogether Group, which is a sustainable local wastewater solution provider, and Grosvenor Place, a premium quality office tower in Sydney's CBD, acquired at a low price after investors deserted the sector despite record low new builds versus improving demand for office space. Within this opportunity set, AI developments have led us to prioritise growth platforms over mature private assets. Building new businesses enables agile operational design and avoids the costs and complexities of retrofitting existing legacy systems. And as with your private equity businesses, we ensure that the specialist management teams operating these infrastructure and property assets are screened for AI literacy. Here are just a handful of examples to illustrate the ways in which your infrastructure assets are actually using that literacy, other than to improve customer service. Telecommunications towers provider Amplitel and our European data centre business Tempus are using AI for predictive maintenance. So sensors and continuous monitoring via machine learning techniques mean that equipment failures can be predicted ahead of time and averted by cost-effective interventions. Diagnostic imaging business QScan uses AI tools to assist their radiologists. They read scans in parallel, and AI tools pre-populate report fields, reducing scan review times from 30 to 20 minutes, but more importantly, they actually improve diagnostic accuracy. European renewables developer Galileo is testing an AI-enabled tool to support faster site selection by more efficiently assessing the likelihood of securing necessary development permissions and grid connections. Galileo is trialling this process on their UK sites today, with a view to progressing across their other European locations. Across the board, we're seeing companies use AI to process and make sense of unstructured data. This includes financial back-office processes, for example, turning long contracts into workflows to manage contractual obligations, or, in the case of Spanish renewables developer Dos Grados, analysing market data that is numerical alongside regulatory and government-published data that's textual to create integrated, automated reporting. A fifth tool in our toolkit that is particularly important for your material private assets is contract structuring. Thoughtful and thorough contract structuring reduces risk by reducing uncertainty across employees, customers, and shareholders. In employment contracts, we align management's financial interests with yours, support agile decision-making, and encourage innovation via idea incubation prior to scaling to reduce the risks. In service contracts, we seek diversified, creditworthy counterparties and structure most contracts as long-term and fixed price. In our shareholder agreements, we structure the ability to enact partial or full sell-downs as assets or the themes that power them mature. This enables us to trade later stage potential upside to entrepreneurial management teams or co-investors in return for a material reduction in downside risk should the future unexpectedly change direction. Finally, over almost 15 years of my team's continuity, we have built comparative advantage in complex deal and corporate problem solving. This reflects in our vibrant international investor manager seeding program. I've been consistent about our investment value proposition at every annual member meeting over the last 5 years. It has not drifted as the world has changed, nor reacted to popular industry practice. It has been purposefully designed around well-founded principles that recognise and plan for uncertainty as perhaps the only permanent feature of the world we live in. Our value proposition, as I said last year, has always been and remains threefold. Firstly, we streamline our offering to focus on 3 complementary high-conviction portfolios tailored to the stages of your working life. If you have a precise view of your risk appetite that differs from your work stage, you can customise using a combination of these options, but every choice delivers top quartile management of the risks you must take to generate the return each option promises and that you need to build wealth for retirement. Secondly, each option is structured to plan for and manage through uncertainty. I've hopefully shown you some examples tonight of how your journey to a comfortable retirement need not be thrown off course, even as the sources, nature and distribution of risks change through time in ways that might be difficult to actually envisage today. Superannuation is not about getting rich quick. It's about building financial security steadily and durably. And finally, we deliver dependable long-term gains in purchasing power. Your savings have grown faster than inflation, providing a surer path to maintaining a comfortable retirement living standard. Because your superannuation is more than just a mandatory savings account or a paper gain or loss at any point in time. It's the promise of a dependable income to your future retired self, so you can live the way you want, not just the way you need. So thank you for your time and your attention this evening and for trusting us with the significant responsibility for growing and protecting your retirement savings. I look forward to your questions.